There is a hidden mechanic that impacts the financial markets the most, yet barely anyone truly understands it. Traders tend to simplify it down to auction, liquidity, supply and demand, you name it. But what if I told you the real reason behind every major move is dealers' exposure and options Greeks? In this video, I will cover all of the Greeks in depth, first order, second order, how they impact the price intraday, how I trade them, how they're being calculated, and the actual trade exam. And before we even start, you might be wondering, why does this guy even talk about options? I trade futures, I trade stocks. Well, when options get bought or sold, a market maker is on the other side. Market makers are not in the business of directional bets. They hedge, and they hedge in the underlying, meaning in futures. So which means their hedging flow lands directly in the market you trade, whether you ever touch an option or not. And you are just obligated to analyze options in 2026 because how huge this market is. So this dealer's exposure is the biggest price driver that ever existed. So nothing moves the price intraday as closely as dealer exposure. So for this entire video, we are not looking at Greeks the way a retail option buyer does. We are looking at them from the market maker's perspective. First and the most important Greek on the list is delta. So from the buyer's perspective, it's how much your option moves per point in the underlying. From the market maker's perspective, it's the hedge requirement. So if the dealer's book is short 1,000 deltas, they buy 1,000 deltas of the underlying, meaning in futures. So you have to understand that delta on its own is static. So it tells the dealer what to hold right now. It does not really generate flow by itself. Of course, you can look at delta exposure intraday. You can observe cumulative delta, cumulative delta flow. But the flow comes from whatever forces delta to change from the second order Greeks. Second one is theta, and it's time decay. So when the book is net short options, theta is income collected every day. So when the book is net long, theta is a cost paid. So either way, it's the carry side of the business, the thing that justifies holding the book at all. Vega is the book's exposure to implied volatility itself. So repricing of volatility can move the dealer's P&L without price going anywhere. This is how options work. So for our intraday purposes, Vega matters mostly as context. So, but the theta side matters a lot because the tension between theta collected and hedging costs paid is the engine behind everything we'll say about gamma regimes. So it's all connected. Now the second order Greeks, my favorite ones. So these are derivatives of delta. They measure how the hedge requirement itself changes. Gamma is delta sensitivity to price, how fast the hedge changes as the market moves. So we all saw gamma exposure levels, and if you want to learn about them, you should watch my next video. But ultimately, we use them as our point of interest. And the next Greek is charm. So charm is delta sensitivity to time, how the hedge bleeds away as clock runs, even if price goes nowhere, even if it stays in one place. That's why charm is often called delta decay. So there's a third one, Vena. It's delta sensitivity to volatility. It's real and it matters, but I check it through a different mechanism entirely. I use Wix and I look at gamma exposure on Wix, and that's its own video. So if you want me to create video on this, you should let me know. Today we're going to focus on gamma and a little bit of charm. So here's the key. First order Greeks describe a book, and second order Greeks force the dealers to act. Gamma forces rehedging when price moves, and charm forces rehedging when time passes. That force flow is the edge. So gamma and charm exposure drive dealer flow, and obvious next question is, where do I get the numbers? And you need to understand that no dealer publishes their book. Every gamma exposure figure, every charm exposure figure you've ever seen is an inference built from the things that are public open interest and the flow of trades. And the best software that I use for this purpose is Quant Data. You can use AR promo code for 20% off and 7-day trial. So there are two ways to make that inference. The industry does not talk about this enough because it's exactly where two charts of the same product can show you different, sometimes even opposite picture. So there are two approaches. The naive approach takes open interest and applies a fixed rule about who holds what. For example, dealers are assumed short the puts and long the calls. And if you apply the rule to every strike, sum it up, and you will have your exposure map. Its strength is completeness. So open interest covers every single exchange and every strike. Its weakness is that it's not as precise as CBOE licensed non-naive data. So the non-naive approach does not assume. So it uses sign, open, close flow to work out what customers actually did and therefore what inventory dealers actually hold. So this is real positioning. That's a real strength. So the weakness is coverage. That's the only weakness that we have here. That sign data comes from the CBOE feed only. You're seeing data for SPX and weeks only, right? So it's not really applicable to NASDAQ, to oil, to other, individual tickers. You only have these two assets. So which approach should you use? Well, the question is, what are you trading? For a product like SPX, where the options trade essentially exclusively on SIBO, the non-naive picture is close to the whole picture. But for multi-listed products, the big ETFs, QQQ, then individual tickers that trade across every options exchange, SIBO is one slice of many, right? So it's not going to cover them. So since I use NASDAQ, I prefer to use data that comes from multi-exchanges. So this is what I use for my levels, for net drift, for wicks as well, right? For volatility. And then for non-naive flow, I use this for overall market sentiment. This is good to know as well, right? So there are two different tools that have two jobs, but of course, intraday is going to matter the most. But before we go over the actual example, let me break down gamma. So I use it for levels. So big strikes carrying large gamma exposure are where dealer hedging concentrates. So they act as magnets and inflection points depending on negative or positive gamma. So you mark them before the session even starts. The same way you would mark volume profile levels, support and resistance, whatever, because they are known in advance. But you should understand that it's not a directional prediction. A big gamma strike does not tell you that price will go there. Whereas, for example, positive gamma is not going to mean it's long or negative. That's the biggest misconception about it, right? So negative gamma surface, it's going to amplify moves, accelerate them. And positive, it's going to act as this rangy environment, but not always, it's not going to depend on different Greeks as well. And if you're interested in the way I trade, you should join my Discord in my bio under this link. I do this absolutely for free. I drop daily pre-market levels. I break down my trades, and I'm going to give away a few prop accounts, so you should check this out. So now let's go over the actual trade example. Let's put it all together. This is going to be Wednesday, 15th July. And here's my pre-market routine. I said that key level for QQQ is 725. It's going to be pivot point, multiple rejections overnight, also positive gamma exposure. Going below 720s would mean entering negative gamma environment. Here I talk about SPX, NQ, tightening a pattern, blah, blah, blah. Positive gamma on SPX validated against 7500 will ultimately act as pivot point, right? So we said that 725 is going to be an ultimate pivot point, right? So and the way I like to do this, I like to mark this up in zone, not just level. And this is the actual trade that one of my students took. That's pretty much the same trade that I would have taken, but I was on vacation, so I'm going to snatch this trade from him. But anyways, This right here, this is pre-market. So what we saw here is 725s, and then around pre-market, I said that's going to be pivot point, right? So we either going to respect it here, and we tapped it overnight, and then that was like kind of continuation here to the downside, right? So we are going to be automatically bearish. But what's going to confirm our bearishness is the options flow. And what we can see here, where I always start, this is my foundation, is net drift premium. This is the best feature, ever created, because you can see who is under control right now, right? So you see that puts are dominating, at this specific market open on both assets. So you see QQQ and DX, these are the assets that I look at. And I dropped my template on my Discord. So I dropped my filters. This is very important to use the right filters, right expirations, as you can see here. So it's very customizable. And then what you see here is that we are bearish. So we already know that if we're going to respect 725, we are bearish, right? So then net drift confirms that. Well, what we need to see right now is we need to see an actual gamma exposure level. So what we saw here, we see 725 is the major level, and then this is the power of intraday gamma exposure. You see at the market open, we've had 90 million around this 722 strike. But then once time passed a little bit, around 10 a.m., you can see this strike started to gain 300 million worth of positive gamma exposure, which is very, very big for intraday, right? So this is the key level for me. This is where I want to take my continuation. And you see that this level aligns with this level on NDX, right? And NDX is the same picture. And this is insane how all of this is going to align, right? So you see this is like completely different, two completely different markets. This is more institutional one, this is like ETF option. So you see that these things align, these two align as well, right? And then what we see on Wix is that we have this 16 strikes. So what you need to understand is that VIX is going to go in the opposite direction from where equities and indices, our main SPX, NTX are going, right? So, but this is going to happen under positive Vanna surface, right? So under negative Vanna surface, we can see misaligning happen, but this is completely different topic. So we see that VIX has the 16 strike that is going to be supportive. So VIX is going to go up, equities are going to go down, right? QQQ is going to go down, NTX is going to go down. Now we have this net drift line on NDX and QQQ. So let's get back on the chart. So now we come back to this 722 level. And this is what happens on order flow. This is also why I combine it with order flow. So you see, we have a bunch of these trapped buyers right here, right? So what happens is that I align order flow with options flow. And what I see here, we have this attempt of buyers to push the price up, but we cannot do this, right? We have this strong level, and this is the reason why. Because let's say if you look at order flow only, you see these buyers, but you don't know why they got trapped, right? So if I look at options flow, I can actually understand why these guys got trapped. So then what we see here is that after we trap these buyers, we see some selling imbalances established, deep effort zone established, and this is exactly where my student took his trade, right? So this beautiful 1 to 5, and this happens on weekly, almost on daily basis.